Okay, let's jump right into this explainer and unpack how the mindset of a 95-year-old billionaire can completely transform the way you approach your very first savings account. Picture this for a second. You're standing at the absolute starting line of your financial journey. Maybe you're just looking at your first real paycheck, or you're finally thinking about opening a basic savings account, and boom, you are immediately bombarded with financial noise. Honestly, it can be incredibly overwhelming. But today, we're going to cut right through all of that. We're breaking down the timeless, step-by-step playbook of Warren Buffett, the Oracle of Omaha himself, and we're going to show you exactly how his wealth-building strategies can be simplified and applied to your own life, starting literally today. To kick things off, we really have to look at this bizarre, almost comical contrast. Imagine the modern Wall Street mindset for a minute. You've got the brightest financial minds out there, grinding through exhausting 80-hour weeks. They're armed to the teeth with quantum computers, hyperfast AI algorithms, complex crypto bots, you name it. They're basically treating the market like a dead sprint, right? Frantically panic selling one minute and FOMO buying the next. Now contrast that chaotic energy with Warren Buffett. He's 95 years old, sitting in an office in Omaha, Nebraska, sipping on a cherry Coke and eating a $3 McDonald's breakfast combo. And yet, he is consistently crushing that high-tech, high-stress crowd. So how does a guy who bought his very first stock back in 1941 still manage to dominate our hyper-digital world? Well, the crucial takeaway here is that Buffett isn't just playing the financial game better than retail investors who get caught up in social media noise and tech bubbles. No, he is playing a completely different sport entirely. Just look at the economy right now. We've got unpredictable inflation, meme stock frenzies, tech bubbles bursting left and right. Every single week, it feels like there's some new expert screaming at you online to buy a random coin or day trade the latest AI startup. Most people out there are treating the stock market like it's a Las Vegas casino. But Buffett, he completely ignores the casino. So let's actually dig into the specific strategies he uses to play his own game. All right, strategy 1, protecting the castle. This is all about the economic moat. If you want to build a rock-solid foundation for your money, you've got to start visualizing your investments as a medieval fortress that's under constant attack. We can really simplify Buffett's famous concept of the economic moat if we look at it this way. Out there in the business world, everyone wants to attack your castle and steal your profits. A moat is simply that wide, deep trench around your castle that keeps the invaders out. It's a competitive advantage that rivals literally cannot copy. Let's think about this in practical terms. Look at Apple or Coca-Cola. When someone goes to buy a smartphone, they don't just want any random piece of hardware, right? They want an iPhone, specifically because of the massive ecosystem attached to it. That deep brand loyalty, that is a massive moat. When you're trying to figure out where to park your very first investment dollars, don't just look for a company that happens to be having a good week. You want to put your money into companies whose castles are practically impossible to conquer. Moving right along to strategy 2, the art of doing absolutely nothing, or aggressive patience. To master this one, we absolutely have to unlearn the cultural myth that making more money requires constant, exhausting hustle. Buffett has this brilliant saying, "The stock market is a device for transferring money from the impatient to the patient." You know, in our culture, we're totally hardwired to believe that more action automatically equals better results. We think that to grow our savings, we need to be constantly tinkering with our accounts, moving money around. Buffett believes the exact opposite. He practices what you could call aggressive patience. While Wall Street traders are out there executing thousands of trades a single day and racking up massive fees and taxes, Buffett literally spends 80% of his day just sitting, reading, and thinking. He can actually go years without buying a single new stock. He just waits quietly for the market to make a mistake and misprice a great company. Which brings us nicely to strategy 3, staying in your lane, also known as your circle of competence. So how exactly has Warren Buffett managed to avoid losing billions of dollars in these massive crypto crashes or speculative tech wipeouts over the years? The secret sauce is his circle of competence. This is the strategy of strictly investing only in industries and businesses that you completely and totally understand. If Buffett looks at a company and he doesn't understand exactly how it makes its money, he walks away. Period. No exceptions. Back during the huge dot-com crash in the year 2000, people were literally calling Buffett a dinosaur because he flat out refused to buy into the hyped-up tech stocks of that era. He just stayed in his lane. And then, well, the market inevitably crashed, all those overly hyped tech companies went totally bankrupt, and Buffett, he looked like an absolute genius. Knowing what you do not know is honestly your ultimate shield against the fear of missing out. So how does this actually translate into your daily mindset? Well, when you open up your phone and look at an investing app, what are you actually seeing? Most people just see these little green and red ticker symbols flashing up and down. They treat the whole thing like a video game. But Buffett doesn't see tickers at all. He sees the corner store. He sees real living businesses with actual employees, real inventory, and everyday customers. Think about it. If you took your first $100 and used it to buy a super successful local corner store down your street, you wouldn't be checking its price every 5 seconds, would you? And you definitely wouldn't sell it in a total panic just because some guy walked in and offered you a lower price for it today. You'd hold on to it because it generates a profit. And that is exactly how you need to view your savings and investments. Okay, on to strategy 4, the rule of 10x. This is all about finding your margin of safety. Benjamin Graham was actually Buffett's mentor, and he taught him a mental model that is absolutely perfect for anyone who is terrified of losing their hard-earned savings, the margin of safety. Think of it kind of like engineering a bridge. If you need to build a bridge that's meant to hold a 10,000-pound truck, you don't build it to hold exactly 10,000 pounds, right? That'd be crazy. You engineer it to hold 30,000 pounds, just in case. That extra padding is your margin of safety. When we apply this to your money, if Buffett calculates that a business is actually worth $100 per share, he is not going to buy it at $95. He will wait for some kind of market panic to drop that price down to $60 or $70. Because he bought it at such a massive discount, even if he's slightly wrong about the company's future, his initial investment is always perfectly safe. And this perfectly explains why his company, Berkshire Hathaway, consistently hoards a massive war chest of cold, hard cash. Everyone else out there is trying to be fully invested at all times. But Buffett knows that economic downturns, recessions, and market panics are completely inevitable. When the bad times hit, most people absolutely panic because they're totally out of cash. But for Buffett, a recession is literally like a mega sale at his absolute favorite department store. Because he has cash ready to go, he swoops in and buys incredible businesses at dirt cheap prices, while everyone else is desperate. Cash gives you the ultimate power to act when things finally go on sale. All right, strategy 5, the ultimate snowball effect, otherwise known as compound interest. Now we're getting to the absolute most magical force in the universe for a beginner's wealth strategy. The crucial point here, and this really shocks most people, is this. Over 90% of Warren Buffett's multi-billion-dollar wealth was generated entirely after his 65th birthday. Let that sink in for just a second. Over 90%. We live in this culture that is just obsessed with getting rich quick, with seeing these overnight TikTok millionaires. But the reality of true wealth building, it's about playing the absolute longest game in the room. If we map out his 8 decades of investing, it brilliantly illustrates how compounding actually works in real life. Look at this. He bought his first stock at just 11 years old. By 30, he was quietly, steadily building his base. By 65, that base began to accelerate wildly. And now, at 95, it is a staggering fortune. It's honestly just like a tiny, fist-sized snowball rolling down a mountain. At first, you can barely even see it growing. But if you keep it rolling long enough, and most importantly, if you do not disturb it, it naturally turns into an unstoppable avalanche. Your first savings account, that's your tiny snowball. Your only job right now is to just get it rolling. Okay, let's pull it all together with strategy 6, your long-term wealth checklist. We have covered a ton of ground today, so let's distill all of these amazing mental models down into a simple, actionable playbook you can actually use. Number 1, look for businesses with that wide economic moat to protect your capital. Number 2, stay strictly inside your circle of competence. Seriously, don't invest in things you don't understand. Number 3, demand a margin of safety so you know you're buying at a discount. Number 4, let compound interest do the heavy lifting over the years. Just leave the snowball alone. And finally, number 5, completely ignore the daily market noise and all those flashing red and green tickers. Remember, winning financially isn't about having the absolute highest IQ in the room or the newest AI trading tools. It is entirely about emotional discipline, plugging your money leaks, and just letting time do the work for you. I really want to leave you with this final provocative thought. You don't need billions of dollars to start applying these rules. You literally just need the discipline to start. So I'm curious, which of Buffett's rules are you going to actively implement in your own portfolio? Or maybe even your very first saving strategy, starting today? Leave your answer down in the comments below, because mastering just one of these principles today is your true first step toward mastering your entire financial future. Keep that snowball rolling, and thank you so much for joining me on this explainer.